He told millions of people to never sell their Bitcoin. He built a platform promising industry-leading yields on crypto deposits. He called himself the People's Banker, the man taking on Wall Street and giving ordinary investors access to returns that only the wealthy used to enjoy. And then one morning in June 2022, he froze every single customer account, and $12 billion belonging to 1.7 million people became completely inaccessible overnight. This is the Celsius Network story. And in May 2025, Alex Mashinsky was sentenced to 12 years in federal prison for one of the most brazen frauds in the history of decentralized finance. To understand Celsius, you need to understand the promise it was built on. Alex Mashinsky founded Celsius Network in 2017. The pitch was straightforward and extraordinarily appealing. Deposit your cryptocurrency with Celsius and earn yields of up to 18% annually. Celsius would lend your crypto to institutional borrowers, generate returns on those loans, and pass the majority of those returns back to depositors. It was positioned as the crypto equivalent of a high-yield savings account. But instead of the 0.5% your bank offered, Celsius was promising 10 to 30 times that amount. Mashinsky was everywhere. He hosted weekly YouTube live streams called AMA sessions, Ask Mashinsky Anything, where he spoke directly to retail investors, answered questions, and built an almost cult-like following. He wore t-shirts that said, "Banks are not your friends." He positioned Celsius as a movement, ordinary people taking control of their money away from the traditional financial system that had failed them. His personal brand was central to the entire operation. He was not just a CEO, he was a populist financial revolutionary. At its peak, Celsius had over 1.7 million customers and $25 billion in assets under management. It was one of the largest centralized crypto lending platforms in the world. Venture capital firms poured hundreds of millions of dollars into it. It received a $750 million investment at a $3 billion valuation in late 2021. By every external measure, it looked like one of the most successful companies in the crypto space. But behind the public-facing promises, the reality was catastrophically different. Celsius was not operating as a prudent lending platform, generating steady returns for depositors. It was making extraordinarily risky bets with customer funds, deploying billions into volatile DeFi protocols, making under-collateralized loans, and engaging in speculative trading strategies that had no place in a platform marketed as a safe, yield-bearing savings product. The returns being paid to depositors were not being generated by the business model Mashinsky described. They were being subsidized by new customer deposits, the defining structure of a Ponzi scheme. The CEL token, Celsius's proprietary cryptocurrency, was at the center of a separate fraud running simultaneously. According to federal prosecutors and the SEC, Mashinsky and other executives were secretly manipulating the price of CEL token. Celsius was using customer funds to buy CEL on the open market to artificially prop up the price. Mashinsky was simultaneously selling his personal CEL holdings into that artificially inflated market, pocketing tens of millions of dollars in proceeds while publicly telling customers that CEL was a strong long-term hold and that he was not selling. He made approximately $42 million from CEL token sales while publicly denying he was selling at all. From an AML and compliance standpoint, the Celsius case is a study in how retail investors can be misled by the gap between a platform's public positioning and its actual operations. Celsius was not registered as a securities dealer or investment advisor, despite taking custody of billions in customer assets and promising specific returns. The yields it offered functioned exactly like interest on a deposit account, but Celsius was not a bank, was not regulated like a bank, and had none of the deposit protections that come with banking regulation. The FDIC does not insure crypto deposits. When Celsius froze withdrawals, customers had no regulatory backstop of any kind. The collapse began in the context of the broader crypto market downturn of 2022. As Bitcoin and Ethereum fell sharply in May and June 2022, the value of Celsius's collateral positions deteriorated rapidly. The risky DeFi bets Celsius had made with customer funds began generating massive losses. The platform was facing a liquidity crisis. It owed depositors billions, but could not access enough liquid assets to meet withdrawal demands. On June 12, 2022, Celsius sent a brief email to customers and posted a notice on its website. It was announcing a pause on all withdrawals, swaps, and transfers between accounts. Effective immediately, 1.7 million customers could not access any of their funds. The notice cited extreme market conditions. It offered no timeline for when withdrawals would resume. Customers who had deposited their life savings, their retirement funds, and their children's college funds woke up that morning to find their money locked with no way to access it. The community reaction was immediate and devastating. Celsius forums and social media channels flooded with accounts of ordinary people who had trusted Mashinsky's public messaging and deposited everything they had. Retirees, young professionals, people who had specifically moved money into Celsius because Mashinsky had repeatedly assured them it was safe. Some had deposited amounts representing years of savings. All of it was frozen. Celsius filed for Chapter 11 bankruptcy on July 13, 2022, less than 5 weeks after freezing withdrawals. The bankruptcy filing revealed the full scale of the disaster. Celsius had a $1.2 billion hole in its balance sheet. The assets it held were worth significantly less than the liabilities it owed to customers. Billions in customer funds had been lost through the risky bets and the CEL Token Manipulation scheme. The legal consequences moved quickly by the standards of financial fraud prosecutions. The Federal Trade Commission, the SEC, and multiple state regulators all launched investigations. In July 2023, the Department of Justice indicted Alex Mashinsky on 7 criminal counts, including commodities fraud, securities fraud, and market manipulation related to the CEL token scheme. The SEC filed parallel civil charges. Mashinsky initially pleaded not guilty and fought the charges. But in December 2024, he changed his plea, pleading guilty to commodities fraud and market manipulation. He admitted to deceiving customers about the safety and sustainability of Celsius's business model and to manipulating the price of CEL while selling his personal holdings. In May 2025, just months ago, he was sentenced to 12 years in federal prison by a federal judge in Manhattan. He was ordered to forfeit $48 million. The bankruptcy proceedings have continued as the Celsius estate attempts to recover and distribute whatever assets remain to creditors. Customers have received partial distributions, but most have not recovered the full value of what they deposited. The 1.7 million people who trusted Alex Mashinsky with their savings are still awaiting the final outcome of proceedings that began in 2022 and continue into 2026. The Celsius case carries lessons that go beyond crypto. Every element of this fraud had a parallel in traditional financial fraud history. The celebrity CEO using his personal brand to build retail investor trust. The promised returns that had no sustainable basis. The use of new customer funds to pay existing customers. The secret insider selling while publicly encouraging others to hold. These patterns have appeared in financial fraud repeatedly across decades. From Bernie Madoff to Stanford Financial to dozens of smaller schemes in between. The technology was new. The fraud was ancient. What made Celsius uniquely dangerous was the specific audience it targeted. Mashinsky positioned Celsius as the solution for people who had been failed by traditional finance. People who couldn't get good returns from their bank. People who were skeptical of Wall Street. People looking for an alternative. He built genuine trust with that audience through years of direct engagement. And then he used that trust to take their money. The warning signs were all there. Yields of 18% with no clear source of sustainable return. A CEO who was simultaneously the chief marketer and the primary spokesperson. A proprietary token whose value was central to the business model. No banking regulation and no deposit insurance. And a consistent pattern of dismissing every critic and regulator who raised concerns as being anti-innovation rather than addressing the substance of what they were saying. If you understand those warning signs, you can protect yourself from the next Celsius, because the next one is already being built somewhere right now. Subscribe to Ledger and Crime for new financial crime cases every week. because the criminals never stop, and neither do we.